Are you missing out on the benefits of investing in property via an SPV limited company? That's the question I'm going to answer in this video for you today. Now, SPV lending has exploded in popularity since 2016. The main reason? You can no longer offset 100% of mortgage interest against your personal tax liability. It's the main reason why you find property investors selling up. They're selling their personally owned buy-to-let. Now, speaking to every limited company lender across the whole of the market, they've all said a very similar thing. SPV lending accounts for the majority of the business that they transact. Now, why has there been this enormous shift from personal ownership to SPV ownership? I'm going to break it down in 3 sections for you.
So here is an example of SPV taxation versus personal ownership taxation if you are a higher rate taxpayer. So the purchase price is £250,000 and you're looking to borrow 75%, so 187,500. That's where the similarities end. The interest rate on an SPV is 5.29%, whereas in the personal name it's 4.54. Just a quick note on that, SPV lending is typically higher than personal buy-to-let lending by around 0.5% to 1%, give or take. Annual interest on the SPV is obviously higher than the annual interest on the personal side because the interest rate is higher. The expenses are exactly the same as well as the rent. The taxation though, 19% on the SPV, 40% in your personal name. So the profit on an SPV, once we deduct 100% of mortgage interest and the expenses, is £4,607. The tax due on the personal side is £4,538 with a profit of £2,549, meaning if you are a higher rate, especially if you're an additional rate taxpayer, it's much more tax efficient to buy through the SPV as long as you're not withdrawing those profits as a dividend.
Okay, so that concludes the tax. Not quite. There are other tax reasons why property investors are liking the SPV ownership structure. Directors' loans. So when you earn money from employment, that money is taxed. It then sits in your bank account. You then loan that money as a director's loan to your SPV, and the SPV uses that money to go and purchase and invest in property. Now, you will have a director's loan account within the SPV. Essentially, because you've loaned the money to the SPV as a director's loan, that SPV owes you that money at a later date. But because the money's been taxed already before it entered into the SPV, HMRC don't double tax you, which means that when you draw out those director's loans at a later date, that money will be free from tax. Bonus. Now, if you are a limited company owner, so in other words, you have a trading business, you're a business owner, that business has retained profits sitting in the business, you can move those profits from that business into your SPV, it's called an intercompany loan, and bypass dividend tax. Once again, bonus. Now, when it comes to succession planning, if you own a property in your personal name, that property is owned in your personal name. In order for you to change the ownership of that personal name, someone technically needs to buy it, stamp duty will be chargeable, need to change the mortgage lenders, etc. Okay, bit of a headache. With an SPV though, there is a layer between you and the property, i.e. the SPV. So over time, what you can do to minimize your inheritance tax liability is to start decreasing the shares that you own within the SPV, perhaps adding your loved ones at a later date into the SPV structure. So what that technically does, as your ownership starts to drop, your inheritance tax bill starts to drop as well. However, keep in mind, there could be a capital gains tax liability. Now, the third, well, I'm not quite ready to give you the third yet. So let's cover a little thing called rental stress tests. So these are the formula that lenders use to calculate how much you can borrow based upon your tax band and the rental income. So for a lower rate taxpayer, it is the annualized rent over the interest rate, so the pay rate, at 125%. If you're a high rate taxpayer, it's the annualized rent, once again, over the pay rate, interest rate, at 145 to 165%, depending on the lender. If you're borrowing through an SPV though, it is the annualized rent over the pay rate at 125%, regardless of your tax band. Got it? Don't worry, we're going to be covering this off in a bit more detail in a second. In our original example, I used a rental income of £1,500, which calculates to £1,800 over a given year. Now, there's no dramas with this particular property. The rental stress test fits on £1,500 based on a purchase price of £250 if you're a higher rate taxpayer or if you buy in an SPV limited company. But what happens if the purchase price is suddenly £350? The rental income is still £1,500, purchase price has gone up. Let's have a look at those numbers. So what does this mean in reality? Well, it means if you're a higher rate or an additional rate taxpayer, you have to put down more money because you can borrow less money. And it also means you can expand your portfolio a lot slower than if you built it through an SPV. But the complications don't stop there. Personal buy-to-let lenders carry out what's known as aggregated stress tests. SPV lenders do this as well. But because you are a higher rate and additional rate taxpayer, they stress that background portfolio at much higher interest rates than they would in an SPV, meaning you can expand your portfolio a lot quicker because you can borrow a lot more money through an SPV than you can in your personal name because of these aggregated stress tests that are carried out in the background. Now also, and this is a bit of a bonus, you can offset any mortgage product fee through an SPV. You can't do that in your personal. Are you eligible for an SPV limited company mortgage? You can book a call with me at my mortgage brokerage, SPV Mortgages. And don't worry, if you don't want to speak to me, go to the buy-to-let platform. You can review limited company SPV mortgage deals there, and we've automatically added into our database all the lenders' rental stress tests. So when you add in the rental income, it will shortlist automatically for you all of the products that you can move forwards with on that specific property. So here's the third reason. Now, so many property investors that I speak to miss this vital point. If you own properties in your personal name and you want to sell those properties, you have to do it individually. So they're individual transactions. But if you own those properties in an SPV, can you guess where I'm going with this? You can sell the SPV. Now, what's even better about that is that one, it's one transaction, but two, the person buying your SPV doesn't pay stamp duty land tax. Remember, there's a layer between you, the SPV, and the properties. The SPV's already paid stamp duty land tax. So the buyer who's purchasing your SPV pays stamp duty on the cost of shares, meaning that in reality, you could split that tax bill in two, meaning you can sell your properties for more money. So with an SPV, you've got to think about the exit strategy. The exit strategy for you might be to build your portfolio and then get to a certain size, maybe sell some, repay the debt on the others, maybe pass them on to your wife, your kids, your loved ones, or sell everything. Now, with an SPV structure, you can literally sell the whole lot in one transaction. Now, it doesn't stop there either, because with an SPV, you can structure your SPVs according to your investment strategy. So you could have SPV Manchester, for example. That SPV focuses on houses in the Manchester area. You could then have SPV Coventry. That focuses on HMO student that's within Coventry. You could then have an SPV London that focuses on flats in London. Now, if one of those SPVs starts underperforming, you could just sell that SPV, redistribute those profits into your other SPV that might be outperforming the market, expand your portfolio in that area, retain that SPV, sell the others. So with an SPV, the exit is so important. And it's one of the things that property investors miss. With SPVs, there are many more options on the exit side than there are in your personal name. So to summarize, the benefits of buying through an SPV on the tax side if you're a high rate or an additional rate taxpayer are significant. Also, the amount of money that you can borrow through an SPV if you're a higher rate or an additional rate taxpayer to expand your portfolio quicker is also significant. And finally, because you're purchasing through an SPV, the exit strategy is so much more stronger and so much more flexible, allowing you to redistribute profits, perhaps sell one SPV, redistribute profits and put it into another SPV, focus on a different geographical area, perhaps on a different property type, is all significant. And these are the three reasons why property investors now are purchasing through SPV limited companies. Now, I hope you've enjoyed the video. If you want to check out a video whereby I talk about buying buy-to-let with no deposit, check this out. Please subscribe to the channel, turn on notifications so you never miss a video, And in the comments below, tell me if you're going to be investing in an SPV or in your personal name, because I'm super interested in finding out.